welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning with your money for your financial and retirement future. He is Chris McIntire, president and founder of McIntire Retirement Services. And Chris, we always appreciate the time that we have you here on the program, sharing your knowledge with us, the insights, the guidance on what strategies we need to know or implement in our planning efforts to get that optimal financial and retirement future we are all hoping for. But it seems like such a challenge, especially when we have the tendency to look back and say, man, I wish I had done this or that, or I woulda, coulda, shoulda done things different, Chris. And I know a lot of us have that kind of hindsight regret when we look at the choices that we've made with our money.
You're exactly right, Peter. Should is a very dangerous word because we all should have done things different, or we all, should have started saving more, or we should have gotten out of the market, right? That's really a bad, that's living in the past, and we can't live in the past and try not to beat ourselves up mentally, for, let's call them mistakes, because look, if we all look back, hindsight's always 20/20. I mean, you and I can say that, as an investment advisor with a fiduciary responsibility to my clients, I should have seen this or that, and I mean, that some of that stuff is so, it's easy to beat yourself up. So please try not to do it. It's very unhealthy.
It's easy to beat yourself up after the fact now that you know more information, right? And that's kind of the double-edged sword of hindsight, is that we've got the benefit of all of the experience, the learning, and the history that has happened since that incident that we are looking back upon. But at the moment, we only had the information that we had. And I think that's why people do beat themselves up for those woulda, coulda, should have done things differently moments. And Chris, I think that maybe the more important thing is that if we do recognize a mistake, we don't continue to repeat the same mistake, because we only get one shot at that ideal retirement. So as we continue to learn and experience, we need to have that shape our behaviors moving forward in a beneficial way. And I know that you have the benefit of seeing retirement many, 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 many times over with all of the clients, all of the savers and investors that you have helped to get there and to make that transition into retirement and make their way through. Most people just want to do it once, right? We want to do it once. We want to do it right. And therefore we need to avoid some of the repeated mistakes or the common mistakes that others have made. And that's what today's program is going to be about, ladies and gentlemen, identifying and helping you to avoid some of those common mistakes. And if you've got questions or concerns, if you would like to get your plan put together, the game plan for retirement, give Chris McIntire and McIntire Retirement Services a call, 800-868-1194. That is 800-868-1194, 800-868-1194, or you can visit online, McIntireRetirementServices.com, McIntireRetirementServices.com. Chris, we had the Groundhog Day weekend, and kind of maybe a tip of the cap and homage to Bill Murray. He got to repeat the same mistakes over and over and over until he eventually got things right. Most of us don't have that benefit either. Don't have the ability to just continue to hone things perfectly until we get them right. We really do have to try to get it right the first time around.
Yeah, you're exactly right. And a good example of this again, Peter, is, look, the Federal Reserve raises interest rates 11 times in a row. We should have went into a recession. So, if we played it cautiously going into that, we were trying to act in the client's best interest, and, the market should have, done this or done that. When I deal with the psychology of the business that we're in, not just the monetary side, right? There's a big psychology piece to what we do. And, sometimes we are in the self-help, profession, buddy, to be honest with you. I mean, we have clients that deal with health issues. We have clients that are dealing with ailing parents and, lots of different things. We all have something going on at the same time. And, then how do we structure this where, try to remove the emotion from the decision-making process? And, there's so much emotion involved in the investing side of things because we all have the hindsight now. It's like, oh, well, heck, look at this. Amazon did 80% last year, just throwing a number out there. We should have bought more of that. And, I mean, that's a really hard thing to to try to help coach people through and building a portfolio where, we're working on solving the income elements. What income do people need? Then we can take an investment approach, because we're trying to remove the emotion of how am I going to live and how am I going to generate my income? Once we get that piece figured out, now we can focus on, well, look, you're not using this money for income. Do you want to take more chances with it? And, there are people listening to the show today that, are so emotionally involved, they don't want anything more risky than a CD paying 4%.
Yeah.
There are other people listening to the show today that are looking at, hey, you know what? I want to jump on the latest bandwagon and I want to, ride that, let's call it the AI wave, right? That's probably the theme of 2024. And roll the dice and, maybe hit a home run or a double or a triple, if you would. And then there are other people that are like, hey, I'll take the boring way here, with a balanced portfolio, and I can live with that. And, so, lots of different spectrums, lots of different emotions come into play, I guess is my point.
And where we fall personally on that spectrum probably determines and dictates a great deal of what we would expect to reflect of the movement of the market. Like you said, the person who all they want is a 4% CD and doesn't want to take risk, they know what they are going to get. But the person on the opposite end of the spectrum who would never be satisfied with just that kind of slow and steady 4% predictability, but wants more aggressive growth, they have to be willing, I suppose is the term there, Chris, to accept and expect the volatility and the fluctuations that go along with investing. But I liked your diagnosis, your analysis there, where you differentiated between the income and the investing. I think even for those seasoned investors, Chris, they have been comfortable with some of those fluctuations with their market-based investments. But I don't think many people would ever be comfortable with those kind of fluctuations in their income. It would be a completely different psychological effect if we see the market go down versus if we didn't have the ability to pay our bills for the foreseeable future. And we've got to recognize and be cognizant of that moving into retirement. And that's why one of your common mistakes is not thinking about retirement as an income issue. I think that's very important for people to be cognizant of.
Yeah, buddy. And, I can think of some folks I've met in the past that, have nice pensions and nice Social Security benefits. That's their income, right? That's what they live on. And then they have investment portfolios. And, if I met them back in like 2022, for example, or early part in 2023, after we had a pretty significant negative movement, they're like, well, look, we don't rely on it, so we don't pay much attention to it. We're going to ride it right through. We're not going to get out at the bottom. And that's just the emotion. They're not emotionally involved in the investment piece because the income side is satisfied. So that's really a key piece that we like to drive home with people we meet. Say, look, let's do this. Let's get the basic investment living expenses satisfied. And then if you want to take some additional risk and, and do some longer term speculation. And again, longer term, folks, is more than the latest news cycle. We're talking years, I think today with so much information out there and, news feeds and people getting updates and emails and whatnot, there's almost so much information out there that, even a long-term seasoned investor thinks that 3 months is a long time, and for you and I, look, 3 years isn't a long time to be a stock investor.
Yep. That time frame really is going to dictate and determine, I think, Chris, the level of risk that we can appropriately take too. So another common mistake, not time optimizing the portfolio, especially in retirement, understanding that for short-term money that we are going to need to spend in the foreseeable near future, 3 years, 5 years or so, should not carry the same kind of risk that longer term money may be able to bear and would be acceptable. Money that we're not going to use for the next 10 years plus foreseeable future, that probably is the appropriate money to keep at risk. But again, this is differentiating what is continued investment money versus what is our income base. And it's such an important part of the planning process, Chris. You spend a lot of time in helping people in that window of transition, the retirement red zone, 5 years before, even 5 years into retirement, or maybe even more, 5 to 10 years on either side of that. Understand the importance of that transition and then structure the assets in order to account for that drastic change. Because the day after we retire, it's not that we don't need a paycheck. It's that we don't have a paycheck. We still have bills that we've got to be able to replace and pay, right?
Yeah, we certainly do. And, you're transitioning right where I wanted to go, because I've got many folks that I've met with that haven't spent anything in the entire time they've worked with us. Maybe they get a required minimum distribution and they give half of that to charity anyway. They're just giving people, and, they're just not comfortable spending money. Maybe they have never done it and they didn't realize they saved enough money where they could do some things. And, I've got clients that they're getting ready to go to Hawaii for their first trip ever to Hawaii. And, they got $150,000 sitting in a savings account. And I'm like, God, would you please fly first class? You're going to be on an airplane for 11 hours. Trust me, having a meal and a place to stretch your leg, that's where you spend the extra little dollars. And why did you do this? You guys, people realize you don't get to come back and do this all over again. And every once in a while, it's okay, in the right circumstance to live a little bit, I guess. I always want to throw that out there. And, if you've got more than enough, it's okay to enjoy a couple creature comforts. You don't have to feel guilty about that.
Is that a hardwired psychology, Chris, that the thing that has gotten people to the point of financial success that they can retire confidently, it's hard to break those behaviors of being savers and trying to pinch pennies and save and invest and not touch the investments, and sort of that carries over into this mistake of not being comfortable to spend some money or not spending money, being afraid to spend.
Sure. Yeah. We call that a paradigm, right? A pattern of thinking, a paradigm. And it's hard to break that because that's what they grew up with, and, grew up dirt poor, and so that's probably why they save so much. So there's a cause and an effect to all of this. And, I just, try to coach them to say, look, hey, it's okay to do a little bit of this. You're not going to hurt anything. And, God bestowed upon you some success and, from your hard work and effort. So it's okay. In speaking of that paradigm, that way of thinking, right? It was always put money into your IRA and your 401k, lower your taxes, and in retirement, because in retirement, you'll be in a lower tax base. Well, taxes have come down. And as you and I talk about, it's like, look, should we be doing, now what we were doing 20 years ago with different income tax rates? So it is hard to break those paradigms, right? And, looking at, should we be putting money into Roth IRAs versus regular IRAs? Because I got to pull that money out at some tax rate. I don't know what it's going to be. And then I got to give it to my kids and they got to pay taxes on it when I pass away at whatever tax rate they're in, right? It's hard to beat the tax rate of 0.
Yeah. Yeah. So, Chris, if I'm hearing you correctly, probably the mistake here would not be shifting paradigms on tax deferred saving and investing. It's not that this one has been a mistake, but it may be a mistake to continue that without rethinking it and maybe really looking and analyzing the tax situation, the tax environment, the tax rates and brackets that we are in today, and then continuing to look forward and planning proactively. It's the tax rates have come down, so it probably was a good deal to defer and delay, but we may be in that shifting paradigm here where we need to rethink that.
Yeah, without question. And, we've talked probably more on this, throughout the course of the year, like we always do, and how important Roth IRA, not only contributions, but converting traditional IRAs to Roth IRAs, how important that is over the longevity of someone's life and what they end up ultimately getting to keep, right? It's not what you make, it's what you get to keep. And making the IRS a much smaller benefactor than what they might be. I think we'll all agree out here. Look, the federal government should not have spent $34 trillion we didn't have, but they did. Okay. And so now what do they have to do? Well, we should be raising taxes, right? To use that should word that I
Yep.
said we don't like to use, but
Yep. Would have, could have, should have, and Chris, with that particular issue, probably will at some
yeah,
point in the future have to raise taxes, right? I mean, there was
yeah,
a politician recently that came out and said that retirement age needed to be moved up to 70 and got a lot of negative blowback about it, but that's something that they've done before. They've moved that retirement age before, and just with the financial situation, the reality that we are in, that's got to be a card that's on the table here for discussion into the future, I would imagine, as we are looking at the spending that we've done and the debt that we've racked up and the lack of funding. I know that Social Security is not supposed to be part of like the general fund to spend out of, the piggy bank for Congress and the government. But unfortunately, again, this a mistake that we have made. Woulda, coulda, shoulda done things differently. Had they been responsible with that, we probably wouldn't be facing the crisis. But they haven't been responsible with any of the money that we've entrusted them with.
Yep, and that's true. And for some reason, we keep putting them back into power. And I guess, maybe we should vote differently.
Yeah.
Anyway, yeah, anyway, let's get off that high horse.
Well, deferring taxes, that is something that if we agree with one point, maybe we need to think about the other one very differently, right? Because continuing to defer taxes leaves those dollars subject to whatever tax law changes may happen between now and then. And Chris, being more proactive with things, here's something that you can do different, taking a look. And you've got some great software tools, some great quantitative analysis that can kind of put things side by side, and you can remove the variables and the assumptions, or at least identify, what is inflation going to be? What is the rate of return going to look like that we are going to assume and be comfortable with? And if those things are kept the same on each side, here's your tax bill if you continue deferring and delaying based on the government's tables and mandates. And then here's the bill that you could have if you manage this proactively. And that's an astounding difference very often, Chris, especially for those who have been more avid savers and investors. A lot of times that bill, the difference in that bill is eye-opening. It can be as much as the balance of the account today, depending on where somebody is in their age and progress.
Yeah, wonderful. Good point there too, buddy. And we've talked about Social Security so many different times, and on the show we talk about the lack of funding that Social Security has. If you read your statement, and you look at the ballooning deficits of the government. So I guess we probably could say, look, let's make the argument that taxes are probably going to go up, not go down or stay the same. Mm-hmm. And then when it comes to that Social Security, a lot of people, will say, I've got to wait until age 67. That's when I get my full Social Security amount. So what do? I want to retire at 65. I'm going to go on Medicare. Okay. How do I pay for that? Okay. And then how do I live until age 67 when I get my full retirement? And, not everybody waits until age 67, right? If, when people come in to me and say, hey, when should I take Social Security? And my answer is, okay, when are you going to pass away? Because that's the answer that we need to know. And most of us don't know that. Some people may know within a range or something based off family history. Well, between 80 and 90 is when my relatives all passed away, and I kind of follow the trend of my mom or something. And delaying taking Social Security until 67 does get most of you listening to the show today. Mine is 67, and I was born in 1965. Gets us our full retirement age amount, but that doesn't mean you have to wait that long, right? Most of our retirement plans that we do for folks is they want to retire at 65, if not earlier. 65 because they can transition to Medicare and, kind of have much more options on the health insurance side than going out to the private market and maybe paying, $1,500 a month, for example. So, a lot of times we build our retirement plans when people are retiring at 65 and taking Social Security, and then they're married in a lot of cases. And when does the spouse take their Social Security, right? So, it's very common for us to tell somebody, say, look, let's have your spouse take Social Security at 62. He or she is home, not working or working part-time. Might as well take it, get some of it going, put it in your retirement fund or your vacation travel fund until you retire at 3 years down the road. And if they were going to get $1,200 a month, that's $14,000 a year for 3 years. That's $50,000 that you have, and that's your travel expenses. So, there is no exact right time to take it because we don't know when we're going to pass away. So, trying to talk through some of those issues there, and don't beat yourself up on, well, I should have waited. We don't know. Again, hindsight's 2020.
Well, if you would like to take a look and uh, quantify the tax liability that you may have on your retirement accounts, your tax deferred balance, if you'd like to optimize that Social Security and run through the different scenarios, look at the different timing and combination of benefits to make the most out of that important retirement cornerstone, pick up the phone, give Chris McIntire a call. Both those things and so much more. It's all part of the written planning process, the game plan for retirement that you will receive if you come and see and talk with Chris and the team from McIntire Retirement Services. There is no cost. There is no obligation. It is a time to get that plan in place for you, to have a plan in your hands that then you can move forward and you can make sure that you are not falling for any common potholes or overlooking anything that could be an obstacle or a pitfall, and hopefully avoiding some of the common and repeated mistakes that sometimes derail retirement or detract from that optimal confidence in retirement. So again, if you would like that plan, pick up the phone, give McIntire Retirement Services a call now, 800-868-1194. That is 800-868-1194, 800-868-1194. Chris also teaches many retirement classes and courses at colleges throughout the area. So if you'd like to find out when those upcoming classes are, you can give a call and just find out the schedule for the year ahead. Find one that is convenient for you or on your timeline for retirement. Always opportunities for you to learn more and to be in touch to get that process started. 800-868-1194, or you can go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, you got a kind of a laundry list of other common financial mistakes you wanted to talk through, but making decisions based on past performance, trying to time the market, either side of the risk equation, right? Taking too much risk, not taking enough risk. We talked a little bit about that. Not accounting for Murphy. I think that's one I'd like to touch on here because a lot of people make pretty rosy assumptions about how things are going to go in the future. But what if we're wrong, right? And Murphy would say, let's assume the worst case scenario. And then if we're wrong about them, we're in a better kind of situation than we thought we would be, right?
Yes, Murphy's Law applies a lot of times, not just at the grocery store as to which aisle you think you're going to get through faster, right?
Yep. Yeah.
That was an analogy that I ran into last week over at the store in Sandusky, Ohio. Murphy thought this line was going to go faster, and Murphy was very wrong.
Once your groceries are on the conveyor belt, you're committed. Even if the next cashier over says, "Hey, I'm open over here," I've already unloaded my cart, and it doesn't matter how long the person in front of me is going to take to pull out the pennies or write the checks. Right? It's I'm committed here. But as long as they catch you before the first grocery goes on that conveyor belt, you can switch there. We can't necessarily switch that easily in retirement once we're already on track. It's like the groceries are already on the belt, Chris, and that's why we need to know and understand things and try to make those careful planning considerations ahead of time.
That's right. Yep. And you can't say I've got a coupon for that expired a month ago, but can I still use it?
No, government is not going to let you off on that. And again, taxes are on sale right now. And if I go into a store, Chris, and I see identical items and one's on the full price rack and one's on the sale rack, I'll probably go pick it up off the sale rack. However, I might still put it back and say, I don't really need to buy that item right now anyway. Well, here's the thing. Taxes are a compulsory purchase. We have to pay them. It's pay now or pay later. So why not pay when they're on sale, right?
Yeah. Great point. Yep, absolutely. And try to control and understand and work in the most efficient manner that you can. I like, but the Murphy's Law is certainly a big one out there because it does strike, and for a good analogy in our world, Peter, would be, the fear of missing out. The tech sector's run so high, and now everybody's going to pile on to that, and all of a sudden maybe drive prices up significantly. And we've kind of seen a little bit of pullback in some of that tech sector. They're announcing a number of layoffs as well. It's kind of funny that it's really hitting the tech sector, not the manufacturing side right now. And again, that should increase profitability down the road. But when you see 8 stocks running and running and running, and all of a sudden you say, hey, should we get on that bandwagon? And it's like, maybe you should do the opposite of what the herd is doing, the contrarian side of that,
Yep.
But also work within a well-balanced portfolio. I mean, you and I have talked about dividend paying stocks forever. I love dividend paying stocks for the long haul. Okay. Does that mean they were a rock star in 2023? They were anything but a rock star in 2023. But all of those companies are still paying dividends. Those dividends are either being used as income, or they're buying more shares of stocks that didn't perform nearly as well as an Amazon, for example. But over time, they help even out. They didn't lose 25% in 2022 either, right? Many of them held very steady because people wanted the income. They wanted something for their money. So, try not just to chase the hot 6 or 7 or 8 that are running right now. They're Magnificent Seven, I think they're calling it right now.
Yep. Everything sort of is cyclical, right, Chris? What is the best one year is typically not the best the following or the subsequent years, and what was maybe the worst performer and out of favor one year eventually does seem to come back, and that's why having that well-balanced portfolio that is risk adjusted for your age, your timeline, your situation is the most important thing. Having the plan in place, ladies and gentlemen. And that's what Chris McIntire does there at McIntire Retirement Services for his clients each and every day. And if you would like to get that plan, pick up the phone, give a call, 800-868-1194, 800-868-1194. Chris, I'm not sure we're going to have time for our 5 questions here to wrap up the show, but maybe one. I want to go back to that individual that's wired and is afraid to spend. Do you have any practical strategies that can help individuals strike that balance and become more comfortable spending their money in retirement and enjoying life?
Yeah, and depending on the type of investments that we're using for them. So, we'll use some index annuities, for example. And so let's say that their index annuity made 5% for the year, and that's an account they can't lose anything in. And so let's say their $100,000 went to 105,000. It's like, look, here's 5,000 you can spend that you earned last year, and you're just spending the earnings. You're not dipping into your principal. That would be a good example. Or, if you've got dividend stocks and you're paying those dividends into a money market account, for example, you can say, look, here's where we started the year. We added $4,000 or $5,000 in dividends over the course of the year. You're not spending principal. This is the work that you did for your money. This is okay to spend. That's probably a pretty good analogy there. And, without going into an expanded software program, but in real life, to bring it up on a computer screen, like, if you've been to the office, we use some pretty good sized monitors here to talk about things and bring up account values and whatnot, and say, look, here's what you made. Here, you want to spend some of it. This would be the time. You got to buy a new car or that type of thing. This is the time to do it. When the market's down, we may say, hey, why don't you, you don't have to do it right now. Probably isn't the best time to do it.
Yeah. Well, as I consider hindsight and looking back, some of the things that I consider mistakes, Chris, I often think of the things that I didn't do rather than the things that I did do. Even if they didn't turn out perfectly, at least I took some action. And I think action is key in life. We regret oftentimes the things that we did not do much more than the things that we did do. And we do need to be proactive and this is a big one, getting that plan in place, right? We don't want to look back and say, I didn't get that plan. Man, I wish I would have, or I should have gotten a plan. Ladies and gentlemen, take that action, take that first step, pick up the phone, give Chris McIntire a call, 800-868-1194. No cost, no obligation. It's an easy conversation with Chris about your financial future, your dreams, your hopes, your goals, your timeline, and how to make that happen. So pick up the phone and give a call, 800-868-1194. That's 800-868-1194. Chris, we always appreciate you being here, encouraging people to take those steps, to be proactive, and informing us of some of those common repeated mistakes that get in the way of success.
Hey, buddy, my pleasure. Thanks for everybody for being with the show. Hope you enjoyed it today. Be safe out there. God bless.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.